Financial position analysis assesses the organization's liquidity, solvency, and overall financial stability as presented in the Statement of Financial Position. It reveals what the company owns and owes and its capacity to sustain operations. Key ratios include current ratio, quick ratio, debt-to-equity ratio, and gearing ratio. Descriptive analysis shows short-term liquidity and long-term solvency levels, identifying whether assets and liabilities are balanced appropriately. For instance, a strong current ratio may indicate sound liquidity management, while excessive leverage signals financial risk. This stage corresponds to descriptive analytics, explaining the current state of financial health. Diagnostic analysis investigates why financial position indicators change. Deteriorating liquidity might result from extended credit terms or rising inventories, while a shift in capital structure could reflect financing strategy or economic conditions. Comparing gearing ratios over time and across industry peers reveals management's risk appetite and funding strategy. Diagnostic insights link capital structure decisions to cost of capital and shareholder returns, highlighting trade-offs between risk and control. Predictive analysis uses trend and scenario modeling to forecast future financial position. It estimates how cash reserves, debt obligations, and asset utilization might evolve under different business conditions. Predictive modeling, such as stress testing or sensitivity analysis, identifies vulnerabilities, e.g., how interest rate increases could affect gearing or liquidity. These insights enable proactive financial planning and capital management. Prescriptive analysis applies these insights to strengthen financial resilience. Management may implement debt restructuring, working capital optimization, or asset divestment strategies to improve position. Data-driven decision-making supported by predictive ratios enhances financial agility and prepares the organization for economic volatility. Reporting on financial position requires clear presentation of ratios alongside management commentary that contextualizes risk and opportunity. Integrated reports should link position indicators to the business model, explaining how capital structure supports strategic priorities. For example, a technology firm may maintain lower gearing to preserve flexibility for innovation investment, while an infrastructure company may accept higher leverage for long-term stability. Effective analysis of financial position blends ratio interpretation with risk assessment and capital strategy. It provides a multidimensional view of stability, aligning liquidity, solvency, and gearing decisions with business objectives. By progressing through the Gartner analytic stages, finance professionals transform balance sheet data into strategic insights that enhance investor confidence and ensure long-term sustainability. Financial performance analysis measures how efficiently an organization generates profit and value from its resources. The primary objective is to evaluate profitability, efficiency, and return through ratio analysis, including gross profit margin, operating margin, net profit margin, return on assets, ROA, and return on equity, ROE. These ratios provide descriptive insights, what happened, by summarizing how effectively revenues are converted into profits. For example, improving gross margin may indicate better pricing power or cost control. Analysts must, however, consider accounting policies and industry context to interpret ratios accurately. Comparative analysis across periods or competitors reveals trends in cost management, productivity, and profitability, linking operational outcomes to strategic performance. Diagnostic analysis goes beyond measurement to explore why performance changed. A decline in operating profit may result from rising administrative costs, falling sales, or non-recurring expenses. The DuPont decomposition of ROE, for instance, reveals the interaction between profitability, efficiency, and leverage. Ratio relationships such as inventory turnover and receivables collection period help diagnose operational bottlenecks. These insights support management in identifying inefficiencies and refining processes. Integrated analysis, combining financial and non-financial data, deepens understanding by correlating employee productivity, innovation, or customer satisfaction with profitability outcomes. Predictive analysis projects future performance based on historical ratios and trend modeling. Forecasts of margins, earnings growth, and cash flows help assess sustainability of profitability. Regression or time series models identify performance drivers, enabling early detection of potential risks. Predictive tools support scenario analysis, how market shifts or cost fluctuations may affect returns. Linking forecasts to the organization's business model clarifies whether current performance aligns with long-term strategic direction. Prescriptive analysis translates performance insights into actionable recommendations. For example, declining efficiency ratios may prompt cost restructuring, technology investment, or product diversification. Management accountants play a vital role in transforming ratio trends into strategic initiatives that improve productivity and shareholder value. This phase closes the analytics loop, using financial data not merely to explain outcomes but to shape strategic action. Reporting of performance analysis should integrate quantitative results with qualitative interpretation. Dashboards and integrated reports present ratios alongside narrative context, explaining management responses and forward plans. Performance should be interpreted relative to the business model, whether the company pursues cost leadership, differentiation, or innovation. A margin decline might be acceptable in a growth-oriented model emphasizing market share expansion. Contextual reporting ensures users interpret ratios meaningfully rather than in isolation. Ultimately, analyzing performance requires integrating descriptive accuracy with strategic relevance. Financial ratios quantify efficiency, while diagnostic and predictive insights explain causes and future implications. Prescriptive interpretation ensures that data drives continuous improvement. In an integrated reporting environment, performance analysis connects profit outcomes with broader value creation, human, intellectual, and social capital performance, aligning financial metrics with long-term sustainability.